are in listen-only mode.
Well, welcome to our webinar this evening. We're so happy to have Matt Sorensen, attorney and author of the Self-Directed IRA Handbook, and he's going to be discussing understanding prohibited transaction rules for self-directed IRAs. So just a little bit of housekeeping before Matt gets into his presentation. If you have questions during his presentation, if you could type them into the chat box, and then he will address all the questions at the end. That would be great. So as many questions as you can think of, as soon as you think of them, you can type them in the chat box, but he'll address them all at the end of his presentation. So without further ado, take it away, Matt.
All right, well, thanks so much. It's a pleasure to be here. Appreciate the opportunity to be teaching about my favorite topic, self-directed IRAs. And I will be going through the presentation here, maybe about 30 minutes, and try and do questions for 10 minutes or so towards the end, but that should be adequate time to get through the material. As I go through the presentation today, just keep in mind, I am a lawyer, so I'm going to give you a disclaimer. This is meant to be educational in nature. Keep in mind it doesn't constitute an attorney-client relationship, and you're always advised to seek out your own attorneys, accountants, or other licensed professionals before entering into other transactions or investments. And now that I've said that, we can get into the actual presentation here. And let me tell you a little bit about me. I am the author of the Self-Directed IRA Handbook. That's what I'm most known for. It's an Amazon bestseller. It was the #1 hot new release in the retirement plan category when it came out in 2014, beating out books by Susie Orm, Brian Tracy, a lot of big-name authors. Sold over 15,000 copies. It's used or endorsed by most self-directed IRA custodians and companies in the industry. It's also used by the National Association for the Self-Directed IRA industry in certifying employees who receive certain certifications in the industry. I'm a partner at the law firm KKOS Lawyers. We have offices in Phoenix, Arizona, which is where I'm at, as well as in Utah and Southern California. I also speak frequently to RITA, that's the National Association in the Self-Directed IRA industry, and I have my own event, which is an annual event called the Self-Directed IRA Summit. That's held once a year out here in Scottsdale, Arizona. It's toward the end of spring training baseball. So the weather here is beautiful, and you can also come learn for a full day about self-directed IRAs. All right, now let's get into these rules here. Let's just dive in. Why not? Let's get into this tax code and some of these IRS revenue rulings. I know it's exciting, but I'm going to try and keep this easy to understand, even though we're talking about some complex subjects. Now, the first thing to understand, even before we get into the prohibited transaction rules, I need to make one preliminary point. The prohibited transaction rules are about whom your account can transact with. They're not about what investments your IRA can make. The only restrictions on what investments your IRA can make are these restrictions right here, these first three. The first restriction is collectible items. Your IRA can't buy collectible items, like art collection, stamp collection, a coin collection, an alcohol, like a wine collection, antique cars or antique items. Sometimes those are investments also. But because of certain abuse issues, the IRS said, you know what, we're not going to let people use retirement accounts to buy collectible items. What happened is people were buying art and hanging it on their office or their home, and they were owning it in their retirement account and as an investment, and it just got to be a problem, and the IRS saw issues with it. People were buying wine collections with their IRAs, and those turned into bottle collections. So they got restricted, no collectibles. You can't buy life insurance. I don't think anyone was here wanting to buy life insurance. And you can't buy S corporation stock with an IRA. Essentially, IRAs don't qualify as S corporation shareholders. That's really an S corporation shareholder rule, not a retirement plan rule. So everything else is fair game. Real estate, LLCs, limited partnerships, startups, private equity, all that stuff's an available self-directed IRA investment. Again, those are the only three things restricted: S corporation stock, life insurance, and collectibles. So the trick really, when you're learning how to self-direct your retirement account, or you're out there and you've been making investments, the most important thing to make sure you're getting right is the prohibited transaction rules. And that's found in 4975 of the tax code, and it has to deal with whom your account transacts with. Not what, but whom your account transacts with. Now the IRS is aware of this, and so they've got some instruction to account holders of self-directed IRAs that basically says, hey, when you're buying stock on the New York Stock Exchange, we know you're not going to have prohibited transactions. We're not worried about you buying stock and selling stock or buying a mutual fund and selling a mutual fund with people you don't even know. It's happening electronically. But when you start buying closely held investments, like real estate or LLCs, partnerships, things like that, there's potential for a prohibited transaction in those things. And because of that, if you've never self-directed your IRA before, you've never needed to know this stuff, because you're always transacting with some electronic party on the other side or someone you never know, buying a mutual fund or stock or whatever you may have had in your IRA. But once you get to a self-directed IRA, you might know the people you're transacting with. You might be partnering in on deals with people you know or family members. You might be going into a company, an LLC, a limited partnership, where you or family members are already involved or are going to be involved. And when that happens, you really need to understand the prohibited transaction rules. That's what we're going to try and make you an expert on today. Now, why do you need to understand these rules? Because you don't want to get this from the IRS. One of the worst things to receive in the mail is a letter from the IRS. And if you get one that's a notice of deficiency, that might be arising because you had a prohibited transaction. What happens is if you have a prohibited transaction, the IRS distributes your entire IRA, makes you pay tax on any amount distributed, and penalty. If you're not 59 and a half yet, you have to pay the 10% early withdrawal penalty, and you no longer have an IRA. What happens is then the IRS starts collecting because you should have paid taxes when the prohibited transaction occurred. So we want to avoid prohibited transactions because you lose the IRA and it causes very negative tax consequences. Now again, we'll be talking about whom your retirement account transact with, not what. Now keep in mind here, one of the main concepts, overriding concepts, is your retirement account cannot transact with you or certain family members. And as we go through this today, there's really going to be 3 different types of prohibited transactions you'll learn about. The first is per se prohibited transaction, which is really the easiest to find. Once you understand the definition, it's easy. The second is an extension of credit prohibited transaction. That's really in specific situations. We'll go through those scenarios to make sure you avoid them. And then the last is a self-dealing prohibited transaction. This one's a little more hard to find and it's very subjective, but I'll try and give you some guidelines on avoiding self-dealing prohibited transactions. All right, now here's a breakdown of those 3 rules and a short definition of them. Now keep in mind the consequence of a prohibited transaction is disqualification of that entire IRA and distribution of that entire account. Let's say you had a $5,000 prohibited transaction in a $100,000 account. Well, the whole $100,000 account's gone. The whole account gets distributed. So again, it's a very negative consequence. All right, let's talk about the first type of prohibited transaction, and that's a per se prohibited transaction. And that occurs whenever you have 3 things happen. You have an IRA engage in a transaction with a disqualified person. Now, transaction really includes purchase, sell, lease, exchange, all those things listed there. Or think of it this way. Anytime money is going in and out of your account, out of your IRA, that's going to be a transaction. Now, disqualified person is going to include you as an owner of the IRA, your spouse, your kids, your parents, and also companies that these people own 50% or more of. So if we look at this list here, per se prohibited transaction, let's say I have my father who owns some rental real estate and he wants to sell it. And let's say I want to buy that property with my IRA. Now if we go through the per se prohibited transaction rule here, it's my father, and my IRA is going to be transacting, buying the property from who? My father, who is a disqualified person as a parent. That's going to cause a per se prohibited transaction. Now if we take a different scenario, let's say it's my uncle who's selling a property. My IRA is now transacting, it's still IRA buying a property, and it's buying it from my uncle. My uncle is not on the list here. Uncle is not a disqualified person. It's a family member, but they're not on the list of disqualified people, so that would be okay. So what really happens is, the trick is, who is your IRA transacting with when it's buying property, selling property, buying an investment, leasing a property, whatever it may be, is who's on the other end of that, or who else is involved, and is that person a disqualified person or not? Now again, the short list here, you're always disqualified to your own IRA, your spouse is, your kids are, your parents are, also any companies that you and these people own 50% or more of. So if you and your husband or you and your wife own 50% or more of a company, that company is prohibited. So let's say it owns a property and your IRA wants to buy that property from that company. Well, if you personally own 100% of it between you and a spouse, or between you and your kids, or you and your parents, whatever that combination may be, if you own 50% or more between those people, that company's the disqualified person, so your IRA cannot transact and buy that property with that company. Now here's the more detailed list here of who is disqualified, and this also breaks down the definitions by individual group here. So we got the owner, also advisors to your account, financial advisors and stuff, those people are disqualified. There's certain exceptions for their fees as long as they're reasonable, but you can't be buying an investment from your financial advisor that they personally own. So here's the list here. Now, it's important to know who's not on this list here, because there's a lot of family members that are not on this list, and I think one mistake people make is they'll say, oh, your IRA can't transact with family members. It's prohibited for your IRA to transact with family members. Well, that's true in some situations and not in others. It depends where they are in the family. This list here is prohibited. Your spouse, your kids, your parents, grandparents, spouses of kids, those are all prohibited. But there's certain people who are not. Now this list right here, by the way, these are all the tax court citations. I know some of you are maybe you're as nerdy as I am and like to read these cases and DOL opinions, but here's the citations for you that break down who is prohibited and not. Now it's really important, the detail here. If you go to family, if you think of your siblings are not disqualified. So my IRA could buy a property and lease it to my sister, who can pay rent to my IRA, but it couldn't lease it to my kids because my kids are on the list. They're disqualified. My sister's not. Siblings are okay. Another one that's weird in terms of who's not on the list is, like I have 3 daughters. My oldest daughter's got a boyfriend. Soon enough, whether I like it or not, I'm going to have a son-in-law. And when that son-in-law comes to me one day, he's going to have this great investment idea, and he's going to say, Matt, or maybe he calls me Dad, I don't know. He's going to say, I got this great investment. Do you want to invest in it with your IRA? I'm going to say, sorry, you're a disqualified person to my IRA, so I can't invest in your business with my IRA because you're a disqualified person. Got an easy excuse. I got an out. So even if I wanted to, I can't. So when you go down the family line, you pick up son-in-laws, daughter-in-laws. You pick up in-laws when you go down the family line. But when you go up the family line, you don't pick up in-laws. This is because the definition up the family line refers to ancestors. That's your own ancestors. Your parents, grandparents, great-grandparents, they're all disqualified to your IRA. But your mother-in-law or your father-in-law, your spouse's parents, they're not disqualified. So my IRA could transact with my mother-in-law. It's never going to, but it could. So mother-in-law, father-in-law are not prohibited to your retirement account. They're not disqualified persons. So just keep in mind the list here. We'll come back if you have any questions towards the end on who's on the list or not. But family members here, that's who's disqualified. Keep in mind also any companies that those family members own 50% or more of. Those companies become disqualified. Now this diagram here really breaks down this list. You can download this image and an article about it from my website, which is at sdirahandbook.com. SDIRAhandbook.com. This image is there, but the parties in green are okay. These are family members you can transact with, siblings, mother-in-law, father-in-law, aunts, uncles, other people distant in the family, other unrelated people. They're all fine to transact with your IRA. All the ones in red here who are disqualified. Similarly over here, this outlines people and companies you may own that can be disqualified. Now, an IRA may not engage in a transaction, or excuse me, may engage in a transaction with these people. I've already mentioned some of these, your siblings, mother-in-law, father-in-law, aunts and uncles. Also, if you have stepchildren or step-parents, as long as there hasn't been an adoption, a legal adoption in those scenarios, they're okay. They're not disqualified yet. Now, here's how you find a per se prohibited transaction. Remember, we need three things. An IRA engages in a transaction with a disqualified person. If we have those three things, we have a per se prohibited transaction. Now, most other IRA deals are an IRA transacting, but it's not with a disqualified person, so we avoid a per se prohibited transaction there. All right, the second type of prohibited transaction is called an extension of credit prohibited transaction. Now, an extension of credit prohibited transaction applies whenever there is an extension of credit between a disqualified person and an IRA. This would happen if your IRA tried to loan you money, or if you were loaning money or guaranteeing money for your IRA. So what the practical ramification of this is if your IRA is going to get a loan to buy a property, let's say your IRA is going to buy a piece of real estate and you're getting a mortgage. The IRA is putting down the down payment and it's going to own the property, and you're getting a mortgage to fund the balance. If you're doing that, you cannot sign the loan personally. You can't guarantee the loan. The IRA can't guarantee the loan. It must be called what is a non-recourse loan. And a non-recourse loan is a loan that the bank lends on the property and says, if you default, we can foreclose and take the property back to pay off what we're owed. But we can't come after the IRA, or we can't come after the IRA owner. Our only recourse in default is to foreclose and take the property back. That's a non-recourse loan. So you can't personally guarantee the loan. Now keep in mind, if you do leverage your IRA's purchasing power with debt, there is a tax called the UDFI tax. There's a separate whole hour presentation about that. You can get it on my website at SDIRAhandbook.com, but we don't have time to get into that issue. It's not really a bad thing. That is something you do need to know about if you're getting a loan, like a non-recourse loan, to increase the purchasing power of your IRA. Now here's a case that came out a few years ago about the extension of credit prohibited transaction. What it was is called Peek and Fleck versus Commissioner. There was two people whose IRAs who formed, Mr. Peek and Mr. Fleck. They had Roth IRAs that formed a company 100%. Their two IRAs, I think, owned 50-50 of the new company. That company went out and bought an existing business. And there was cash from the IRAs that funded the new company and put down a down payment to buy the existing business. Well, the seller of the business financed the rest of the purchase. And the new company signed a note to the seller to say, hey, we'll pay the rest of this that's owed over time. Now, the seller required Peek and Fleck, however, to sign personal guarantees. Even though Peek and Fleck didn't own the LLC at all, their IRAs did, they signed personal guarantees for the debt that the company their IRAs were invested into obtained. They also put up their own personal homes as collateral for the debt. And the problem with that is that caused an extension of credit prohibited transaction because they were guaranteeing the debt for their IRAs. Even though they invested through your company here, the IRS still treated that as an extension of credit from them personally to benefit their IRAs. So they had an extension of credit prohibited transaction. Now what happened, again, the consequence of prohibited transaction, both of their IRAs were distributed. And the bummer part of this for Peek and Fleck was they actually made a great investment. They ended up selling this business for over $1 million profit. And they would have received that in their Roth IRAs if they didn't sign the personal guarantees and put up their homes and have a prohibited transaction. But because of the prohibited transaction, they no longer had Roth IRAs. So now when they sold this $1 million profit, doesn't go back to Peak and Flex Roth IRAs. It went to Peak personally and Flex personally. They had to pay taxes on all that gain instead of letting it go to Roth IRAs. So that's one more reason to make sure you're paying attention to these rules and not committing a prohibited transaction. All right, now the third type of prohibited transaction is called a self-dealing prohibited transaction. Now this is the most complicated one to find because it's very subjective, and frankly the cases are a little inconsistent when you get to applying the rules. There are some rules in practice though that are pretty straightforward to follow. Now essentially what a self-dealing prohibited transaction is that'll occur whenever a disqualified person, again, you the account owner, your spouse, your kids, your parents, whenever any disqualified person benefits from an IRA's investment. Whenever that happens, you're going to have a self-dealing prohibited transaction. So for example, if my IRA buys a property and I'm a real estate agent and I get the buyer's agent commission because I'm also, I'm licensed to get that. That's going to be a self-dealing prohibited transaction because I'm benefiting from my retirement accounts investments. Let's say I have an IRA LLC. My IRA owns 100% of an LLC, and I'm the manager of the LLC. We set those up a lot for clients. And I say, all right, I'm going to pay myself a salary. Well, now you're benefiting from your IRA's investments. That would be a self-dealing prohibited transaction. You can't do that. So self-dealing prohibited transaction occurs whenever a disqualified person benefits from the investments. You always want to avoid making any money or receiving any compensation or commissions from your own IRA's investments, and making sure your spouse, kids, parents are also having the same, not receiving compensation. The second rule in practice is you can't use the IRA assets. So sticking on the real estate theme here, if my IRA owned a rental property, and let's say it was a vacation rental, I rented it 51 weeks out of the year to unrelated people, and there was 1 week where no one was going to stay in it, so I said, oh, I'll just go stay there with my family. Well, now that's a self-dealing prohibited transaction because I'm benefiting from my retirement account's investments. My retirement account owns the property. I'm disqualified. I'm benefiting by being able to stay there personally, as would my kids, as would my parents. So that would cause a self-dealing prohibited transaction. Now some people say, well, what if I paid my IRA for that week? Now I'm not benefiting anymore because let's say I paid whatever the rental rate anyone else would have paid. All right. That's not a self-dealing prohibited transaction, but what did I just do? I'm a disqualified person and I just paid rent to my IRA. I got out of a self-dealing prohibited transaction, but I just caused a per se prohibited transaction because that was a disqualified person paying an IRA. That's a per se prohibited transaction. So bottom line, if your IRA owns assets, if you use them and don't pay for them, it's self-dealing. If you use them and do pay for them, it's a per se prohibited transaction. Either way, it's a problem. So don't have use or any benefit of your IRA's investments or assets. All right, now there are situations where you can have cases, let's say you own 33% of a company and the other 2/3 is owned by just friends or other unrelated people. And that company, you want your IRA to transact with that company, loan the company money, buy something from the company, buy shares from the company, whatever it may be. It's possible for your IRA to do that because you don't own 50% or more. Remember, if you or disqualified people own 50% or more, you wouldn't have a chance. But if you own 49% or less, and let's say in this example you owned 1/3 personally, it's possible for your IRA to transact as long as you're not benefiting or there's no conflict of interest involved in the transaction. And that's really hard to summarize on a webinar. It's very case specific. There's a case called Mullins versus Commissioner. It's in my book, the Self-Directed IRA Handbook. I go over the case and the factors, what the court looked at. In that case, Rollins' 401k loaned money to a company he and his wife owned about 30% of. And there was actually multiple companies he and his wife owned 30% of. And the tax court found a self-dealing prohibited transaction because he was involved in making the deal. He was signing for the company, even though he was only a 30% owner. He was the signer for the company on getting the loan from his own 401k. And so they found a self-dealing prohibited transaction because there was so much personal involvement, and they deemed that he would personally benefit as a large owner of the company. So It's a tricky situation, under 50%. Make sure you're always getting advice from an attorney or CPA that's very familiar with the rules and can advise you about it. Again, avoid compensation to disqualified people. And the next thing which is important is you have to avoid what are called step transactions. You can't just put a person in the deal and say, all right, my dad's got stock he wants to sell in a startup to my IRA, but my dad can't sell it to my IRA because my dad's prohibited. So he's going to sell it to my sister, and then my sister's going to sell the stock to my IRA because my sister's not disqualified. Well, that's considered a step transaction. You can't just move ownership or assets around to straw people to get around the rules. The IRS would apply that scenario I just gave just as if your IRA bought property from your dad. They're just going to go through that, your sister that you put in the middle to get around the rule. Now there's also something called the DOL Bulletin on Prohibited Transactions. This basically says that if you enter into a transaction, let's say your IRA invests in a company, and that company then is required to transact with a disqualified person, that would cause a prohibited transaction. One of the cases was an IRA invested into a company, less than 50%, but then that company owned property that was going to lease to the IRA owner. And that the IRS said would be, or the DOL, excuse me, said would be a prohibited transaction if the person's IRA invested into a company and then the company was required to transact with that IRA owner personally. That would be a prohibited transaction. Now when it comes to self-dealing, another flow chart here, we have an IRA. Is someone receiving compensation or benefit from the IRA's investment? Yes. Is that person receiving compensation or benefit a disqualified person? If so, we have a self-dealing prohibited transaction. Now keep in mind, whenever we have a prohibited transaction, there's distribution of the entire account, and there's taxes and early withdrawal penalties on the distribution depending on the person's tax situation, whether they're 59.5 or not. But the entire account is no longer an IRA. Now as we saw in that peak and flex example, they had Roth IRAs, but they engaged in an extension of credit prohibited transaction. So all the gain they would have made on that deal, they didn't get the preferred tax treatment anymore. They had to claim it personally because they no longer had Roth IRAs. So you lose that preferred tax treatment, which is a huge perk and benefit of using any type of IRA. Now if you have a prohibited transaction, and let's say you have other IRAs that are not involved, those are unaffected. But the entire account that's involved in the prohibited transaction, that entire account is distributed. The different IRAs, though, if you have them separate IRAs, those are not affected by the prohibited transaction, unless they were also otherwise invested and involved. Most prohibited transactions are discovered in company audits or transactional audits. IRAs are rarely audited, but there are obviously transactions they're involved in or companies they're involved in that get audited, and sometimes prohibited transactions are found in those audits. You could have a prohibited transaction discovered by your custodian, so don't ask your custodian prohibited transaction questions. You want to consult with an attorney in those scenarios who can have attorney-client privilege. But sometimes a custodian will find your prohibited transaction and distribute your account because of it. There are audits of IRAs and 401ks, but they're less common, particularly for IRAs. And then also sometimes you see cases in bankruptcy if an IRA or 401k goes into bankruptcy. Sometimes you'll have a bankruptcy trustee claiming a prohibited transaction because they want to distribute your account so that creditors can get at your account. Because retirement accounts are protected in bankruptcy, so if a bankruptcy court or trustee can find a prohibited transaction, you can lose your retirement account and they can use that money to pay all your creditors. So not a good scenario for account owners, but it's one where we've seen bankruptcy courts be pretty aggressive in trying to find prohibited transactions so people lose their retirement accounts and have to pay creditors. Now in terms of a statute of limitations, there is a statute of limitations on prohibited transactions. It's a 3-year rule, and that's generally what the IRS audits for. The prohibited transaction manual for Internal Revenue agents tells them to audit for prohibited transactions in a 3-year cycle. They can audit up to an additional 6 years if they get supervisor approval, and they can claim a prohibited transaction if you did not disclose it in the first 3 years. Now, frankly, most people don't disclose in the first 3 years, so it is possible for them to go up to 6 years. It's a little more detailed to that rule, but for practical purposes, it's really a 3-year cycle. Again, that's the time period IRS agents are told to audit. So, for example, we're in 2016 right now. They would be auditing 2015, 2014, and 2013. All right, now I want to let everybody know I do have a free self-directed investor toolkit with a number of webinars, videos, and articles for self-directed IRA investors. You can get that at my website, which is sdirahandbook.com. It's right on the home page. You just enter your name and email, and you get immediate access to it, emailed to you. It's very useful. I highly recommend it. Of course, my book, The Self-Directed IRA Handbook, you can find on my website as well. It's also on Amazon, where it's a five-star reviewed and is a bestseller in its category. And then if anybody needs consulting advice or wants to consult with me or my office on prohibited transactions, or you need an IRA LLC, any of those things we can help with. My contact information for the law firm is there. Just give my office a call. Or you can also email me at my email, matt@kkOSlawyers.com. All right, now if you've got some questions, I'm going to go through the chat window. I'm going to look through to see if anybody's entered any in. And then also if you have some right now, go ahead and enter any questions in the chat window, and I'll come back and address them here in just a moment. All right, everybody's being shy, so let me make sure I'm not missing these. Maybe I just did a really good job presenting, but I don't see any questions here. Last call though, last shot. Anybody's got questions? I mean, I'm 400 an hour, so I'm free right now. If you got any questions on prohibited transactions, feel free to throw them in on the chat window.
Somebody did raise their hand, Matt, so if you could just type your question in either the question window or the chat window, that would be helpful. I know I did see a hand go up. I want to make sure I give everybody the opportunity. But now I guess she's being shy because I saw the hand go up.
Well, maybe I covered it by then.
Nope. There it is. Let's see. Okay. International transactions in real estate. If you can please shed some light.
Okay. A self-directed IRA can own international investments. Of course, with all the different countries out there, every country is unique and different. For U.S. and retirement plan rules, a retirement account can own investments in international and a foreign country. They just can't be, a banned country. That we have to have a trade treaty with them. Pretty much, you're bad actor. Are you trying to buy property in Syria or invest there? You're not going to be able to. But if you're going to Mexico or Canada or most of Europe or the Bahamas, you're okay. The trick, though, really is getting control of those investments. Most custodians, I don't know about next generation, but most custodians don't want to hold like foreign real estate or foreign stock in your IRA directly. The rules are too complicated, the reporting's too complicated, there's foreign languages involved in a lot of things. So what most of our clients do with international investments is we use an IRA LLC. Their self-directed IRA will end up owning an LLC, and then their U.S.-based LLC will go into the foreign country to own the asset or investment. And sometimes they'll set up a company in the foreign country that their IRA LLC owns. That's probably that's 99% of foreign investments that our clients do. They're using an IRA LLC. Just administratively, it's easier to pull off that way as you're going into foreign countries, because a lot of foreign countries don't know what an IRA is, they don't know how to treat it, but they know what a U.S.-based LLC is. It's also easier on your custodian as well. And we set up IRA LLCs if you need one. It's $800 plus state filing fees to do an IRA LLC. And what happens there is your IRA owns an LLC 100%. You're manager of it. There's restrictions on what you can and can't do. If you get my free self-directed investor toolkit, I've got some videos and webinars on that show how the IRA LLC works. I've also done one with Next Generation before too. They probably have it on their website, a prior webinar on the IRA LLC.
Okay, Matt, here's another question. We are using our real estate as an Airbnb income stream managed by a brother-in-law. We believe we are compliant. Is there any specific issues that we should be concerned about or may trigger an audit on that type of investment?
That's a big question. That's possible. I mean, you can have, there's no problem using Airbnb or VRBO, things like that, to rent out places. The issue is, this is a UBIT issue in some ways. I mean, you don't want to be involved. You got the brother-in-law handling it. That's great. They're not disqualified. But one of the other issues is, what's the income you're receiving? You want to get rental income. Rental income is exempt from a tax called UBIT tax. There's this tax called UBIT, unrelated business income, tax that can apply to certain IRA investments. Now, generally, investment income that your IRA gets, you don't have to worry about UBIT tax. But business income or ordinary income your IRA gets, that causes this UBIT tax for an IRA. So investment income is like capital gain income, rental income, interest income, dividend income, the typical stuff an IRA would generally receive. That stuff's always exempt. There's exemptions for that. It does not cause UBIT. But rental income really requires it to be rental and passive in nature. If you're renting property on a nightly or possibly even weekly basis, and you're also providing services, the IRS may look at that and say, that's not rental income, that's operating income. That property is more like a hotel than it is a rental. And if it's more like a hotel than a rental, you're providing services, you have short-term stays, weekly and nightly, then you've got a problem. That could cause UBIT tax. Now, there's differences of opinion on that. You want to seek out your own accountant, but frankly, you want to make sure you're getting rental income. If you're renting it out on a monthly basis, you're fine. But that's the primary thing that can be an issue. It's not a big one. I don't know, it's just one we ran into for clients renting property that may be, nightly or weekly rental. There are some potential workarounds around that. You could rent the property to a property manager on a monthly basis, and then they rent it out weekly and nightly. Frankly, that's what most hotels do. They have owners of the hotel or the property, and then they rent it to a management company on a monthly rental, and the management company rents it out weekly and nightly, to people who stay there.
Okay, let's see if there's any other questions. These are great questions. Why is it important to have an attorney set up an LLC for an IRA?
Well, a lot of the companies, require it. So one, you don't have a choice in some scenarios. But more importantly, an IRA LLC, that's what we call that. Some people call it a checkbook control IRA, but we call it an IRA LLC. It's very unique. Even if you own other LLCs and you're familiar with an LLC, you're not going to operate this LLC in the same way. You've got to make sure you understand the rules. So most of our work is done, we set up a lot of IRA LLCs, and we require clients. I could sell documents all day long for this and not have to do anything. But there's no way we'd have clients have success with it. They'd screw it up, they'd mess it up, custodians would be upset. Account owners would be upset, they have problems with the IRS. It's just not a good way to do it. So what we do is we make you do a consult with the attorney, and we have malpractice. We do an opinion letter that says it was set up properly. And that's really what people need. When you're looking into investing, $100,000 or a few $100,000 from your IRA, or maybe even $1 million or more, you don't want to go get a set of documents you bought online from who knows who. You want to get advice from a lawyer who's licensed to give you the advice, who has malpractice, and who knows what they're doing in the area. And so this is an expertise of ours, and we're not the only people out there, but I highly recommend getting an attorney. Make sure you get a consult so you understand your scenario and how the LLC works in your scenario, whether you need to file a tax return for it or not, how you can put more money in if you need to, who can be the manager, what can the manager do, These are all things you need to make sure you understand in your situation and get advice about. And that's what we do when we set them up. And our fee's $800. It's not a lot of money. If you set up an LLC on LegalZoom, it's like $675 to do a full LLC. They advertise $99, but that's just files your articles. But if you want to get the full LLC where you get everything that you really need for a company, it's $675. So we're not really that far off on pricing, and you actually get a consult with the attorney. And the IRA LLC documents are very unique to to the IRA rules. And every custodian is going to run it through compliance, make sure it has those provisions before they'll allow the IRA to invest and put its money into it.
All right, let's see if there's any other questions. Let's see. I have an IRA LLC that loans funds to another LLC that another one of my self-directed IRAs is 30% owner of that LLC. Is that prohibited?
Okay, so you have an IRA LLC that your IRA owns 100% of, and that LLC loans money to a company your IRA also owns 30% of. Did I get that right?
Yeah, a different self-directed IRA owns 30%
Oh, a
of it.
different self-directed IRA.
Yes.
That could be an issue. That could be a self-dealing conflict of interest, prohibited transaction. So if it was 50% or more, you definitely couldn't do it. Because you're below 50%, it's possible. It just depends on the factors. Basically what the IRS would look at and what I would make sure you're doing is that it's at market rate. Are there other investors investing under the same terms that you are? Is you're transacting one IRA with another IRA? I try and avoid that scenario. If you are doing it, I just make sure that you understand, how a self-dealing prohibited transaction occurs, and the facts are really important. It could be a prohibited transaction, it could not. I'd have to really get into all the detail on the terms of the transaction and who's making decisions in the company that's getting the investment from the IRA LLC. So, and I would read that Rollins versus Commissioner case that I mentioned earlier. It's in my book, a summary of it, and you can find the case online too.
Okay, let's see. Are there any other questions? Everybody had great questions. Does anybody else have anything? No, I don't think so. Let me check all the chat boxes. Again, we did record this, so if you do want to hear it again, we will make this available on our website, also on Facebook. So, if you do want to hear Matt go through the prohibited transactions again, by all means, listen to the recording again. Does anybody have anything else? Wow, everybody got shy now.
That's great. Wow. Maybe we just taught it so well.
Yeah. Well, it was really a great presentation, Matt. Thank you so much.
All right. Well, thanks, Karen. Thanks for having me.
Oh, no problem. And have a great night, everybody. Thank you, Matt.
Take care.